Beneath the desert sun, Saudi Arabia is racing to reinvent itself. Once defined almost entirely by oil, the kingdom is now chasing a bold new future, one filled with skyscrapers in the sand, artificial cities, and dreams of a post-oil economy. Vision 2030, the crown jewel of this transformation, promised to reshape the region and the world's perception of Saudi Arabia. But today that grand vision is facing growing pressure. Behind the gleaming headlines about NEOM and The Line, oil prices have plunged. Foreign investors are pulling back, and the country's finances are under strain. So what's really happening behind the scenes? Oil prices have taken a serious hit recently, and that's a huge problem for a country like Saudi Arabia, whose economy still heavily relies on oil. In fact, things have gotten so tough that last week, their finance ministry quietly admitted they've borrowed more money in the first quarter of 2025 than ever before. That's a red flag. So in this video, let's break down what's really happening. Why oil prices crashed, what it means for Saudi Arabia's $100 a barrel dream, and how this could impact their economy going forward. To understand why this matters, we need to start with Vision 2030. Saudi Arabia is one of the world's top oil producers, and actually the biggest exporter. We're talking about around 90% of their export earnings, 80% of government revenue, and roughly 40% of their GDP. Even the remaining 60% of GDP is still largely influenced by oil money. That might sound like a jackpot, but it's actually a huge problem. Politically, this kind of reliance means oil alone can't generate enough jobs, especially for a population that's growing fast and increasingly young. To keep unemployment down, the government has basically had to invent jobs, which is why about 2/3 of working Saudis are employed in the public sector. That's not a sustainable setup. Economically, the dependency leads to something called Dutch disease, a term used when a country's heavy focus on one export, like oil, hurts its other sectors. When oil prices go up, the local currency gets stronger, making non-oil exports less competitive internationally. Plus, it's just risky to depend so much on something so unpredictable. Oil prices are wild. For example, between 2007 and 2011, prices doubled, halved, then doubled again. In 2016, they tanked to multi-year lows. And in 2020, during COVID, they actually went negative for a moment. That kind of volatility makes smart long-term economic planning nearly impossible. So, back in 2016, Crown Prince Mohammed bin Salman introduced Vision 2030, a bold plan aimed at transforming Saudi Arabia into a more modern and diversified economy. The core idea was to reduce the country's heavy reliance on oil by focusing on two major strategies. First, they wanted to develop non-oil sectors like tourism, mining, and manufacturing so these industries could eventually thrive without needing government subsidies. Second, they aimed to strengthen the domestic economy by investing in areas like education, infrastructure, and support for small businesses, which would help boost local demand and reduce the country's dependence on imports. This plan wasn't just a vague vision, it came with concrete targets. By the year 2030, the goal is for the private sector to contribute 65% of the country's GDP, for half of all exports to come from non-oil products, and for renewable energy to generate 50% of the nation's electricity. Ambitious, right? Maybe even too ambitious. After all, many oil-rich countries have tried to diversify their economies, but only a few have succeeded. Norway is one of the rare examples, and even they took decades to do it by carefully saving and investing their oil wealth. Saudi Arabia, in contrast, wants to make this leap in just 14 years. To make Vision 2030 happen, Saudi Arabia needed one crucial thing: money. A lot of it. So, after the COVID-19 pandemic, the Saudi government made a strategic bet. They'd try to push oil prices up to $100 a barrel. That kind of revenue would give them the financial cushion needed to fund their massive transformation plans and eye-catching mega projects. At first, the plan seemed like it might work. Saudi Arabia leads OPEC+, a coalition of major oil-producing countries, including Russia. By working together to cut oil production, they hoped to tighten global supply and drive prices higher. But things didn't go as planned. Despite their efforts, oil prices have mostly hovered around $80 a barrel since the pandemic. There are several reasons to it. Non-OPEC countries like Canada, Brazil, Guyana, and especially the United States, thanks to its booming shale industry, have been increasing their oil production, offsetting OPEC+ efforts. On top of that, the Biden administration stepped in and released oil from the U.S. Strategic Petroleum Reserve whenever prices climbed too high, keeping a lid on global rates. To make matters worse, even within OPEC+, some members weren't playing by the rules. Countries like Iraq, Kazakhstan, and the UAE were producing more oil than their agreed quotas. And in 2024, Angola decided to leave the group altogether. Fed up with the lack of cooperation, Saudi Arabia decided to take matters into its own hands. It slashed its own oil production by 2 million barrels per day, dropping output to the lowest levels seen since 2011. But that decision came at a cost. Less oil production meant less revenue, at a time when the country's expenses were already skyrocketing thanks to the high costs of Vision 2030 projects and high-profile ventures like the Saudi Pro League. As spending went up and revenue came down, Saudi Arabia started running chronic budget deficits. According to Bloomberg Economics, they now need oil prices at about $110 a barrel just to break even. And now, we hit the real turning point. In early 2025, oil prices took another dive, falling to around $60 a barrel. The immediate trigger was a sharp drop in global demand after what some analysts are calling Liberation Day in Trump's second term, which brought economic uncertainty and policy shifts. But there's another twist. The Saudis themselves began reversing some of their earlier production cuts, a quiet admission that their $100 a barrel strategy had failed. Goldman Sachs estimates that if prices stay this low, Saudi Arabia could face a $67 billion budget deficit in 2025, more than double what the government had forecast. It gets worse. Earlier in May 2025, their finance ministry revealed the country borrowed $16 billion in the first quarter of 2025 alone, the highest quarterly borrowing in Saudi history. If they keep borrowing at this rate, we're talking about a $64 billion deficit for the year, roughly 5.5% of GDP, which would rank among the highest deficits in the world. Now, it's not like Saudi Arabia is broke. They've still got big cash reserves, and their debt-to-GDP ratio is around 30%. Which is low compared to most countries. But they don't want to burn through those reserves too quickly. A big chunk of that money is used to keep the Saudi riyal pegged to the US dollar, which helps keep inflation and imports under control. Also, insurance costs to protect against a potential Saudi debt default have shot up to the highest level since 2020. That's not a good look. And this is where things get really serious. If oil prices stay low, Crown Prince Mohammed bin Salman might be forced to dramatically scale back Vision 2030. Not just trim it around the edges, but cut it down so much that it barely resembles the original plan. And we're already seeing hints of that happening. Some of the flagship projects, like NEOM and The Line, have been hit with repeated delays and redesigns. Meanwhile, foreign investors, who were once excited by the grand vision, are starting to back away. Rising costs, slow returns, and growing regional tensions have made them nervous. Just a few years ago, Vision 2030 was being promoted as a shining example for the whole Middle East. A roadmap to a future beyond oil. But now, it's looking more and more like a cautionary tale, showing just how hard it is to build a new economy when you're still relying so heavily on the old one. So where does this leave Saudi Arabia? They've got bold ideas, deep pockets, and big ambition. But the reality is, oil prices don't follow your plans, and the global energy market is shifting fast. If they can't find a way to balance the books and restore investor confidence, Vision 2030 might end up being remembered more for its missed targets than its futuristic dreams. Let me know what you think in the comments. Can Saudi Arabia pull this off? Or is the dream already slipping away? And if you found this breakdown useful, don't forget to like, subscribe, and hit the bell so you don't miss the next video. Thanks for watching.